Just like they're absurd the other way, it's absurd this way. To see gold rally by $130 on this when it should have been rallying the whole time, because this inflation is real. It's not going anywhere, and it is a function of the war. And for the market to believe that the Fed has to lower rates for gold to go higher is absurd. And if you look at how the central banks have been inelastic in their gold purchasing, doesn't matter if the currencies were strong, it doesn't matter if rates were high, they continue to purchase gold. Tells you the real story, and it's just silly that the markets are behaving this way. And it instead of seeing the big picture, they focus on the leaves instead of the forest, the rustling leaves of the trees. And I think it would be 50-50 at best if this gets ratified.
So regarding gold rallying on war news, there's been some confusion there, because typically gold is a safe haven asset,
Right.
rallies when there's geopolitical escalation, and doesn't rally when there's peace, shall
Right.
we say. And we've seen the opposite during this conflict.
Right.
Initially, there was a spike in the first day, but then as this conflict continued and even intensified, gold did not rally on escalating geopolitical tensions. And now we have, we'll call it a deal, or what people are interpreting as a deal, and gold is rallying on peace, not rallying on geopolitical uncertainty, which is the opposite of its usual safe haven function. So what's going on there?
Yeah, it's just the belief, this stupid, illogical belief that the only road to higher gold price has nothing to do with the fundamentals. It only has to do with whether or not the Federal Reserve will be dovish rather than hawkish. And if the Fed were to lower rates, why then gold will do very well. But because inflation is ignited through the war and oil prices go higher, which drags the CPI higher, which drags the inflation level higher, why then the Fed has to pause on rate decreases, and maybe even, as the market has been signaling, move towards a rate hike like we just recently saw in the European Union, and many expect to see in Japan in the next couple of days. And so, which again is silly, because we saw gold move massively in the highest and fastest uptick in interest rates in history, from roughly 0 to 450 basis points in a very short period of time, yet gold kept moving higher. So it's convenient for them to bring out this narrative, to roll out this narrative when the price is getting hit. And it's faulty as far as I'm concerned. And what betrays it is the amount of gold we continue to see being delivered. In the month of June, we've already seen close to 13 or 14. I haven't checked it today. As of Friday, a couple of days ago, it was approaching 13 billion in deliveries on COMEX. Now, that doesn't mean it left COMEX, but someone or some ones are standing for delivery, prioritizing physical delivery over cash settlement. This is massive. These people who are standing for delivery for 12 billion, 13 billion of gold in the first 10 days of the month, which follows a pattern we've seen for 18 straight months, that to me betrays all the price action. And it's the silly market that is falling for this narrative, while the central bankers, they're laughing all the way to the vault with what they're accumulating.
And focusing on just one angle, right?
Yes.
Just focusing on the Fed
It's
angle.
silly. It's stupid. It's not real.
And the idea is that higher rates increase the opportunity cost of holding gold. I mean, that's usually the sentiment, that gold doesn't yield rates and you're better off having, and also less liquidity driving into gold.
I mean, but look at it. You right now you got the CPI up at what, 4.6% month over month, and from the last read, and or is it year over year? Whatever. The point of it is the uptick of almost, I think it was 60 basis points for the month. You're approaching pandemic level inflation, and so the level of inflation is at or higher than the rate that you're going to get. And we know the inflation number that they tell us is a bunch of nonsense.
Right.
So the point of it is you're at almost basically at real negative returns, and yet we're supposed to believe that this is enough to entice people from owning gold to own dollars that are being bled away in value, being paid an interest rate that barely, and if we were being honest and using shadow stats numbers, massively puts you at a negative return.
And again, even if this deal is legit and it sticks and it holds, we still don't know what the long-term accumulative inflation impact is of the fact that we've had this conflict for 100 days.
There's a big lag effect, and that lag effect hasn't happened yet, but it will. And I think most people know that the inflation that they're feeling, the grocery store with tuition, with insurance, that it's much higher than the 3-4% we are led to believe.
Well, and we also have a new Fed chair coming in to take his first meeting. Kevin Warsh. He will also hold a press conference on Wednesday, which of course will be widely watched. And this meeting is widely expected to produce no change in interest rates, despite President Trump's demands that the Fed keep cutting, as he was making very clear to Warsh's predecessor, Jerome Powell. But sources are saying that the president trusts Warsh, so he will give him some scope of action. People familiar with the Trump-Fed dynamics, speaking under condition of anonymity, told CNBC that he's going to give him a lot of free range to do what he wants, and that he will attempt to use that freedom to make his case internally for some big changes at the Fed, his regime change that he said he wanted to do. There are reports that could include how Warsh and the Fed calculate inflation. And Warsh is expected to focus more heavily on whether inflation is being driven by monetary expansion rather than external shocks. This is what he said during his Senate confirmation hearings. He said, "The measures I prefer are looking at things that are called trimmed averages. A trimmed mean inflation measure essentially removes the most extreme price moves from the calculation, allowing policymakers to focus on what they view as the underlying inflation trend rather than temporary spikes." So this brings up two questions. First, what are your expectations from Warsh in terms of keeping rates steady, potentially hiking rates, potentially cutting rates for the near term? And do you see him and the Fed coming up with another measure of inflation, which then down the line could justify rate cuts because they bring inflation down to 2% under this new calculation, should they implement that?
Yeah, this trim measurement, it in essence lops off the highs and the lows, the outliers, if you will. And it would put it right now at just barely over 2%, which is close to the mandate. Yet the PPI numbers from May come in at 6.5% above expectations, or 6.5% above expectations of 6.4%. And it's the highest level since the pandemic, since 2022. And so the PPI numbers, the producer price index, is kind of the precursor to the CPI. How much does it cost for the producers to produce this stuff? Inflation came in at 4.9%. And so, you are very close to these pandemic levels. And so inflation is real. And for them to trim it again and make it seem as though the rates are much lower, to me is a pipe dream, at least in terms of how it will deal with the real problem of inflation. Whether or not they do it, I guess they probably will do it, but the average person is just going to be hurt every bit as bad regardless of that number.
Explain what that means for the average person when it comes to purchasing power, because we throw out PPI, CPI, trimmed means, this calculation. What it actually means is that your dollar is buying you less.
Yeah, and if you look at the amount of money that's flown into the money market accounts, as an example, which are paying right now not even 4%, and there's trillions of dollars in the money market accounts of people who are in there supposedly for the safety and just to get a return, their real return is negative based upon the real CPI right now. And so that really is going to make anyone who looks at it with a discerning eye say, what the hell am I doing here if I'm actually going backwards? Especially any sophisticated trader would say, I'm out. But when you trim it again and blur the reality of what inflation truly is, you may catch more people sleep, if you will, and accept that negative real return.
But there was some talk that Warsh will try to rein in quantitative easing, that he wanted to.
I think he will.
How does that happen?
I think he will do that in January with the passing of the Genius Act. See, this is the part that the mainstream is ignoring, Michelle. To me, the passing of the Genius Act neuters the dual mandate of the Fed. because the Genius Act says anytime money moves after January 1st, it will be primarily backed by 90-day or less short-term treasuries. You pin the front end of the curve to the floor. And so that mandate of the Fed and their interest rate adjustments, when anytime money moves, it is synthetically creating demand for short-term treasuries. The Fed overnight lending rate, the very, very front end of the curve, will have zero impact when anytime money moves, whether you buy a pack of cigarettes or a new house, it's backed by short-term treasuries. This will paste the front end of the curve to the ground. And so you'll have very, very low rates with the ability to then to slowly repair your balance sheet. Now, that again would move, let's hope, into Judy Shelton's idea of backing the back end of the market with gold. And if that were to happen, you could actually, I mean, this is the argument I've been making, foolishly perhaps, kind of like I did with BRICS in 2019. I don't hear anyone else saying this. So either I fall on the sword, or again, I just have the stupidity or the courage to say something I believe, which is the front end of the curve is done with the Genius Act, as is the dual mandate of the Fed. The back end of the curve would be backed by gold. You would be able then to, if all of the money, this and the Clarity Act says you can't transfer the interest, and we see what Tether has been doing, buying more gold than anyone but the country of Poland. And Bo Hines is the CEO of USA Tether, the Genius Act compliant portion of this. He was Trump's crypto czar. If there was a wink, wink, nod, nod deal, and this is a supposition, but if they were to let gold go higher and higher and higher and higher by taking that interest and pummeling it into gold, and that is the deal that they worked, gold goes higher, the dollar goes lower, you sell manufacturing to the public, to the world rather, you bring back manufacturing at zero upfront costs if you can back the back end of the treasury market with gold. And I don't know, to me, it is doable if all of this pans out. July 4th will be a big deal. I don't think I'll go to sleep July 3rd.
You know, Andy, so many of the themes that you've discussed over the years are sort of culminating together, and we'll break those down. I mean, you have long said that you need a weaker dollar because of Triffin's dilemma, because you want to onshore manufacturing, you need the United States
we have to, our kids are dead.
You've said that. You've said they were going to kill the dollar but save the system by backing treasuries with gold. And a lot of, well, this isn't getting much attention, but it is very interesting that Kevin Warsh, the new Fed chair, has brought on Paul Winfrey.
Yeah, that freaked me out when I saw that. It truly did.
Now, let's explain why. Because Winfrey is a former Trump administration economic advisor, and he authored the Federal Reserve chapter in Project 2025, a conservative paper where he discussed the possibility of introducing gold convertible treasury instruments and even allowing a parallel commodity-backed monetary system to operate alongside the current fiat dollar. Now, you've been talking about this for quite some time, and you've suggested that we could see this happen. And this is the first hire by the new Fed chair, someone that has written extensively on linking gold back to the monetary system. Now, he's been hired reportedly as an interim advisor, just so we're clear. But again, he wrote this chapter in Project 2025 on the Fed. Project 2025 is a policy blueprint developed by the conservative think tank. The Heritage Foundation was developed ahead of the 2024 US election. It got a lot of hysteria from some of the left media. But the nearly 900-page document lays out recommendations for how a future conservative administration could reshape the federal government, and it covers everything from foreign policy and energy to regulation, the Federal Reserve, and monetary policy.
Which was his chapter.
And that's where we're getting to. Now, his argument in the chapter on the Federal Reserve was that introducing gold back into the monetary framework could help restore fiscal discipline and limit the government's ability to expand spending through debt and money creation. And here's a quote written by Winfrey from Chapter 24 in Project 2025. And he writes, "Beyond full backing, alternative paths to gold backing might involve gold convertible treasury instruments or allowing a parallel gold standard to operate temporarily alongside the current fiat dollar. These could ease adoption while minimizing disruption, but they should be temporary so that we can quickly enjoy the benefits of gold's ability to police government spending. In addition, Congress could simply allow individuals to use commodity-backed money without fully replacing the current system." Again, no one is saying that the US is about to return to a gold standard, but it's very, very interesting that this hire by the new Fed chair
First hire, yeah.
is advocating something that you have suggested, along with Judy Shelton, could be the solution.
And I don't think we're going to go to a gold-backed system. We're going to go to gold-backed treasuries, which will allow monetary stupidity to continue. However, the gold within the backing of the treasury will be kind of the alarm bell, if you will, to that monetary stupidity. And case in point, you get Van Eck funds, their emerging bond market team came out and wrote a report and said if the dollar loses reserve status, Triffin's dilemma, we could see gold going to $139,000. So when Judy says, we can sell a 50-year bond deliverable in gold or dollars with zero coupon at the end of the 50-year period, and in her book she said 5, 10, 20, 30, 50, but starting with the 50, that means zero upfront borrowing costs, number one, because there's no upfront. You just sell the bond, you get the money. You have to deliver the gold, no interest payments, but gold at the end of the maturity. If the dollar continues to lose value because the interest that is not transferable is piled into gold, pushing gold higher and the dollar lower, gold being the only neutral barometer, the only neutral reserve asset by which everything is measured, yeah, I think this can actually happen. But it allows the Fed to continue, it allows monetary policy to coexist with gold backing of the treasury market, not backing the dollar, because that's when you can't expand the money supply if there's not enough gold. However, you can still do that and sell bonds redeemable in gold. That is the whole purpose of having the redeemability in gold, because if the world believes that we will not find fiscal sanity or monetary restraint, then indeed they will choose, the gold instead of the dollars or any small interest